Anti-money laundering risk assessment. Conducting a compliance risk assessment is one of the most critical responsibilities of a compliance officer. As global regulatory frameworks continue to expand, organizations face increasing pressure to identify and address compliance vulnerabilities. To meet regulatory requirements and to align with the expectation of customers, regulators, and other stakeholders, compliance professionals must ensure comprehensive risk coverage across all areas. A compliance risk assessment involves analyzing all potential ways in which an organization could fail to meet its obligations. These obligations may be legal, regulatory, civil, criminal, or contractual. One of the key objectives of this process is to identify gaps between the organization's current compliance practices and the measures that should be in place to effectively mitigate risk. In alignment with international standards, the Financial Action Task Force introduced in its revised 40 recommendations of February 2012 the concept of the risk-based approach, or RBA, as a cornerstone of global AML, counter-proliferation financing and terrorism financing policy frameworks. The risk-based approach, or RBA, is designed to allow both competent authorities and financial institutions to apply preventive measures proportionate to the level of risk identified. This enables organizations to prioritize resources effectively and strengthen risk mitigation strategies. To implement an effective RBA, entities must establish processes to enable them to: Number 1. Identify risk. Number 2. Assess the likelihood and impact of those risks. Number 3. Monitor and continuously evaluate risk exposures. And number 4. Manage and mitigate the risk through targeted controls. The overarching principle of a RBA is that higher risk scenarios require enhanced due diligence and stronger controls. We will talk later about due diligence. While lower risk situations may allow for simplified measures as long as there is no suspicion of money laundering or terrorism financing. An effective MAL CFT risk assessment process typically includes the following key stage. Number 1, risk identification. That means recognizing potential MAL threats within the organization activities, products, services, customer base, and geographies. Number 2, risk analysis. Evaluating the nature, source, and magnitude of the identified risk. And number 3, risk control and mitigation, implementing and adjusting controls to reduce risk exposure to acceptable levels. By integrating a well-structured risk assessment into the compliance program, organizations not only exchange their legal and ethical standing but also protect their reputation and build trust with stakeholders. Let's go more deep into these stages. Number 1, the risk identification. Organizations are exposed to a variety of compliance risks when they fail to adhere to applicable law, regulations, internal policies, or code of conduct. Identifying this risk is the first and foundational step of an effective compliance program. To develop a comprehensive risk list, organizations should consider the following factors. Number 1, context and industry. Number 2, geographic location, core activities and operations, organizational structure, legal and regulatory obligations. Additionally, it is recommended that compliance officers and designated teams interview key personnel across departments to gain a deeper understanding of operational processes. These interviews can reveal potential risk areas where regulations, standards, or ethical codes might be violated, intentionally or unintentionally. Once these insights are gathered, a list of specific compliance risks should be compiled. This list should be cross-referenced with current laws, regulation, and internal standards to verify compliance. Let's go now to risk analysis. After identifying compliance risk, the next step is risk analysis. This involves assessing the likelihood and potential impact of each risk to support informed decision making. Tools for risk analysis. Well, we can use the risk matrix. A risk matrix is a tool used to categorize and prioritize risks based on their probability and impact. It helps visualize which risks require immediate attention and which are less critical. Note, a heat map is a type of risk matrix that uses color coding, example, red, orange, green, instead of numerical or descriptive scales like low, medium, high, to indicate risk levels. All heat maps are risk matrices, but not all risk matrices use heat maps. By evaluating risk using a matrix, organization can determine the risk score for each scenario and decide an appropriate control or mitigation strategy. Let's go now for stage 3, risk control and mitigation. An effective compliance management depends on the ability to prevent, detect, and respond to risks. This requires robust control and ongoing verification of their effectiveness. Key steps: define roles and responsibilities. Ensure that all employees are aware of their roles in managing compliance risks. For example, employees should understand how to recognize and report unusual transactions or client behavior. Number 2, implement preventive and detective controls. This may include automated systems, approval workflows, audit trails, and compliance checklists to prevent breaches. Foster a culture of continuous improvement. Risk is dynamic. As organizations evolve, new regulations emerge, employees change, or technologies are adopted, risk exposure change too. Therefore, compliance risk assessment must be ongoing and cyclical. This system should be continuously reviewed and improved. Number 4, employee training and development. Regular and targeted training is essential to keeping employees informed and capable of fulfilling their compliance responsibilities. Data accuracy and updates. Maintain updated client profiles and documentation using a risk-based approach. This helps ensure compliance and supports better risk classification. And for the last, leverage data and technology. Utilize data analytics and compliance software to detect suspicious activity, monitor transactions, and automatically regenerate reports. These tools help reduce human error and improve compliance oversight. Let's navigate through a real risk assessment form of a financial institution. In this case, we have two examples of forms. One is for a simple risk assessment, that is the one you are looking right now, and we have another one that is for a full risk assessment. So it depends on the rigorosity of the financial institution. Both forms are included as the downloadable resource for your use. In this example, we are performing a risk assessment for a tech company. As you can see, the account name, we have Technology and Import Corp. We have also the account number and the type of account. In this case, is a current account. As we go down, you can see for account rating, when we are performing the risk assessment, for an account rating, in this case we select a current account, we have a qualification of 3, and in this case automatically this table pop-ups that this is a high risk level. In the second point, we have economic activity that generates the fund deposit into the account. We have selected IT and custom logistic consulting services. Here we have a list of other services that we can select, and depending on what we select, it will change here the qualification. Okay, so we're still remaining the IT. in this case the high risk level. Then for the last we have country where the economic activity that generates the fund takes place. We have selected Russia with a qualification of 3 and risk level of high. If we select another country, for example United Kingdom, we can see here that it changed a qualification of 2. So if we remain in Russia, we have 3 here, and it will automatically here it will put the risk level according to these 3 points. So in this case this client is a high risk level for the financial institution. Also in point 4 is the account operation profile declared in the product opening application reasonable? We put here yeah. 5. Is the client a political exposed person or PEP? No. Here we have the signature of the account officer. Also this form have the confirmation if we may perform a blacklist verification. In this case we make a verification through the OFAC list and the bank blacklist. In both cases we may perform the verification and there's no agreement. Also for blacklist verification we have here some solution like word check. We talk about this about word check in previous chapters. United Nations Security Council negative list and SafeWatch, that is another solution. And this you can see is a simple risk rating form for a financial institution. Let's work now on a full risk assessment form of a financial institution. In this case, this form have several columns like description, category, subcategory, and the calculation where we have the word, the weight, and the final score. Let's navigate on this form. First, we have the nationality. We have selected a Mexican, and automatically it gives us the word, the weight, and it calculates automatically the final score with these 2 values. The country or jurisdiction of birth of the client, Mexico. Country or jurisdiction of residence, Mexico. Here you can select from the list. Main activity is retired. It's a retired person. And insurance activity or pension is the income that he received. Type of record not applicable. Jurisdiction of the main activity, Mexico. Original funds is a salary. Destination, Mexico. PEP is not a PEP. Total monthly income from $0 to $5 million. Product type, testamentary trust, is opening a testamentary trust. Type of assets in guarantee, account, deposits, security or investments. Services, checks. Other services, bank account, management. Channels, we have type of transactions, monthly transaction amount, frequency, time of relationship, this is an existing customer, and the history of the relationship. All of these points have a total score that automatically calculated, and at the end we have a total value. In this case is 256. If we could go to the table in the left, we can see that for this total value we are in the range of a low risk. Probably you are being asking where does this frames come from? Well, it comes from a risk classification that the financial institution must perform, and it depends. The results depends of the status of the global or national economy, the amount of loans, and whenever they are being paid on time. Also, they consider other type of variables that depends of the institutions. In here, they put the score that every factor have, and finally they have the values for each kind of risk level. And here you have all the form completed that you can download. As we mentioned at the beginning, you can download and you can use it for your professional purpose.